The weak 0.24% month-on-month rise in the U.S. core CPI for December has sparked heated debate in the market over when the Federal Reserve will cut interest rates. Based on this data, Citigroup predicts a rate cut cycle will kick off in March, which seems to offer clear guidance. But if we look beyond the surface of the numbers, this forecast is fraught with uncertainty. This is due to statistical distortions caused by the government shutdown, lingering inflation stickiness risks, and multiple constraints on the Fed's policy-making process. This weak data isn't a foolproof green light for rate cuts. While it came in below market expectations, it's riddled with unsustainable anomalies. The government shutdown led to carryover estimation biases, triggering a mechanical rebound in prices of clothing, furniture, and other goods in December. The 1.8% surge in recreational services also stemmed from data revisions or one-off adjustments. Meanwhile, the 3.3% sharp drop in wireless phone services reflects a structural shift that's unlikely to repeat. These irregularities have severely undermined the data's reference value, making it unable to truly reflect the full picture of inflation. It's clearly hasty to predict a policy pivot solely based on this abnormal and hard-to-interpret data. The core trend of slowing inflation still needs verification. Even though recent inflation figures have kept trending downward, they're still far from the Fed's 2% target, and stickiness risks remain. The 2.9% strong rise in hotel accommodation prices and the 0.7% uptick in food prices, both part of housing-related inflation, show that inflation still has underlying support. This round of U.S. inflation has evolved from a structural issue to widespread price hikes, and the impact of the wage price spiral hasn't been fully eradicated. Cutting rates hastily based on just one questionable data set could repeat the mistakes of the inflationary cycles seen in the 1970s. That's why the Fed prefers to wait for more convincing evidence. Divergent views among institutions have further highlighted the uncertainty. Citigroup stands by its March rate cut call, though it already pushed the timeline back from January. Goldman Sachs and Morgan Stanley are more cautious, eyeing June instead. J.P. Morgan Chase has even scrapped its 2026 rate cut forecast entirely. The root cause of these differences lies in varying assessments of data validity, labor market resilience, and other key factors. The Fed also faces multiple constraints on its decision-making. The job market hasn't shown signs of weakness. Economic growth remains resilient, leaving no urgent need for rate cuts. The number of hawkish members on the Fed has grown, making it hard to reach a consensus on a policy shift. And the sky-high government debt, which has surpassed $38 trillion, has also limited room for monetary easing. A Fed policy pivot is by no means an isolated event. Any misstep in decision-making could trigger a global chain reaction. Right now, global financial markets are highly sensitive to Fed policies. The European Central Bank and the Bank of Japan's policy adjustments are influenced by the Fed's moves, while emerging markets face pressure from capital outflows and currency depreciation. Hasty rate cuts could fuel disorderly global capital flows, while waiting too long might drag down the economic recovery of both the U.S. and the world at large. So the Fed can't be easily held hostage by a single institution's forecast. In summary, the rate cut expectations fueled by December's CPI data are more of a temporary outburst of market sentiment. With data uncertainties lingering, inflation stickiness persisting, and sharp divisions among institutions, Citigroup's March rate cut prediction needs to be backed by more follow-up data. For the Fed, sticking to a data-dependent approach and waiting for a solid trend to emerge is the prudent choice. For the market, it's time to let go of over-interpreting single data points and view uncertainties rationally. At this crossroads in the economic cycle, policy precision and stability far outweigh speed.